Volatility at the end of 2018 was a wake-up call for individual investors. On the heels of the longest-running bull market in history, the final 3 months of last year saw sustained volatility and raised questions about what the future holds. But did investors take those declines to heart? I'm Dave Goodsell, Executive Director of the Natixis Center for Investor Insight. According to our recent global survey of individual investors, they definitely acknowledge last year's volatility. But they're just not sure what to do about it. Here are 6 key insights from our findings. Number 1, investors are conflicted about risk. They like the idea of taking risks to get ahead, but they're far less comfortable taking bolder action in real life. Number 2, investors also need to understand how much risk they can handle. Our survey shows that despite their confidence, their knowledge here is shaky. Number 3, return expectations. In spite of the volatility, investors want to see returns of 11.7% above inflation, the highest targets we've recorded to date. Investment professionals say 5.5% is more realistic. Number 4, assumptions about index fund risks need a gut check. Many investors are confused about the fundamental differences between active and passive investing. Number 5, for fixed income, the complicated math of bonds is hard for investors. Many just don't understand how interest rate movements affect their fixed income investments. And number 6, Q4's volatility and losses have pushed investors to take a harder look at how diversified they are, rekindling an interest in alternative investments. Here are 2 key issues that investors are grappling with today. First, fixed income. Our survey reveals that most investors may need a refresher course on bonds. It's no surprise, bonds are complicated. Investors say they're concerned about rate hikes and name them among their top 5 risk concerns for 2019. We asked them what that meant to them. Most don't know that rate hikes negatively impact their bonds in the short term. Even fewer understand that those same hikes today could benefit them in the long term, since those rate hikes would ultimately drive their future bond income up. In fact, only 3% of investors we surveyed understood that both issues are at play with bonds. And 60% just plain don't understand the relationship at all. Second, active versus passive investing is an area where investors have some fundamental misconceptions. A majority of investors say that last year's volatility made them realize that their index funds were riskier than they thought. That's why it's surprising that more than 60% overlook that experience and somehow still say they believe index funds are less risky. And 64% believe they'll actually help them minimize losses. The fact is, many index funds may not offer downside protections since they don't have any built-in risk management. So how do we make the lessons of last year's volatility stick? Investing can be confusing. Education and advice are critical. At the end of the day, investors need to understand how these factors really impact their portfolios. To get the full story on investor sentiment in the wake of volatile markets, read our full report and download our executive overview.